Hello, everyone. Thank you all for joining us today for our Protecting Your Credit Union with Vendor Risk Assessments webinar. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use, including Ask Question, Media Player, Slides, Related Content, Speaker Bio, Request Demo, and Help. If you are unfamiliar with our webinars, all the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide the widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner of the widget. If you experience any issues or have technical questions, you can use the Help widget or submit them along with any other questions through the Ask Question widget. Don't worry, we do capture all questions throughout the session. We will be answering some during the webcast, but those that we do not have a chance to answer live, we will address with you via email. Today's live session is eligible for 1 CPE credit. If you wish to receive this credit, please remember to be logged in individually with your own credentials, answer all 3 of the polling questions that appear on your screen during today's presentation, be in attendance for the entire live 1-hour session, and complete the follow-up survey. We will send the link to that follow-up survey 24 hours after the live session concludes. If you meet all requirements, we will send your CPE certificate within 7 to 10 business days following survey submission. With us today, we have Christine Kitamura, Vinlander Senior Content Manager of Education. She will discuss the basics of vendor risk assessments and what you need to know and do to ensure your assessments are effective, timely, and meet regulatory requirements. You will see a link to a copy of today's slide deck, a link to our website, a link to our samples library, links to our How to Review Third-Party Risk with Vendor Risk Assessments ebook, our 7 steps of risk-based vendor due diligence infographic and matrix, our Inherent Vendor Risk, Sample Questions, and Next Steps ebook and questionnaire, as well as a link to a library of additional resources, all within the Related Content widget. With all that being said, I would like to hand it over to Christine. The floor is now yours.
Hi, everyone. Thanks for joining today's session on protecting your credit union with vendor risk assessments. I think this is a really important topic to cover because risk assessments can be kind of a confusing concept. The NCUA has some guidance on risk assessments, but they don't really describe how they should be done and who's involved in this process. Of course, the exact details might look a little different for each credit union, but I hope that today's session gives you a better understanding of how to perform risk assessments effectively throughout your own third-party risk management program. So before we dive in, I'll review some of the highlights of today's agenda. I'll talk a little about the role risk assessments play in your third-party risk management program, as well as some of the responsibilities of different stakeholders. I'm also going to cover the elements of a vendor risk assessment and how you can use the results in your due diligence process. Next, I'll explain the difference between inherent risk and residual risk and 4 different risk handling techniques. And finally, I'll show you how you can implement risk assessments in your ongoing monitoring activities, and I'm going to review some of the regulatory expectations around risk assessments. To start off, I just want to give you the big picture of where vendor risk assessments fit in the third-party risk management lifecycle. You'll notice that risk assessments take place during the first 2 stages highlighted here, onboarding and ongoing. During the onboarding stage, risk assessments are one of the first things you'll do before you officially select the vendor and sign the contract. The risk assessment will identify the types and amounts of vendor risk you'll be dealing with, and this information is essential for nearly every other activity in the life cycle. During the ongoing stage, we call these risk reassessments, and these are done periodically throughout the vendor relationship. And the goal here is to identify any new risks that may have occurred after that first assessment was completed. And even if there aren't any new risks, a reassessment is necessary to simply have that documentation that the vendor relationship hasn't changed since the contract was signed. Here are just some of the basics that are good to know before I get into the details of the process. Starting with who is involved. Generally, risk assessments should involve your vendor risk management team, vendor owners or vendor managers, and internal or external subject matter experts. Now, what about the actual process? This includes three main activities. First, it's analyzing the product, service, and vendor itself to determine the level of risk posed to your credit union and your members. Next, it requires identifying any issues with the vendor relationship and implementing a plan to remediate those issues. And finally, risk assessments should include documentation and reporting. Vendor risk assessments should be performed both before and after you sign the contract and whenever a material change occurs. And finally, vendor risk assessments are necessary because they're considered a sound business practice that protects your credit union from third-party risk, and they also add strategic value by identifying which vendors will require more attention when it comes to other activities like due diligence, monitoring, and contracting. And also, risk assessments are required by regulators who will expect to see a documented process of how you're identifying and mitigating third-party risk. Now that we know who's involved in vendor risk assessments, I want to spend a little time looking at each role and their specific duties and responsibilities in the broader context of your vendor risk management program. Depending on your credit union, you might have a dedicated vendor risk management team or maybe just a single individual. This team should be responsible for that overall vendor risk management framework, such as the rules, tools, and processes that your organization uses. So if other stakeholders like vendor owners have an issue with a particular process, the vendor risk management team should be responsible for resolving it. This role should also own and maintain the governance documentation like the policy and program, as well as the vendor inventory, risk rating systems, and whichever methodologies you have in place. So because the vendor risk management team is owning that framework and documentation, they're also going to oversee and direct those activities that are identifying and assessing vendor risk. This doesn't mean that they themselves are performing those activities, but they are holding everyone else accountable by making sure they're following procedures and completing tasks on time. Here's a general list of some of those responsibilities and how they relate to vendor risk assessments. First of all, the vendor risk management team should be establishing the criteria of criticality for your organization. Criticality is a classification that basically states whether or not a vendor is essential to your operations. This team should also be determining the methods you're using to identify and rate inherent and residual risk. They're also coordinating with vendor owners and SMEs to make sure issues are remediated. And one especially important responsibility is setting the schedule for those periodic risk reviews and due diligence. When you're dealing with a large vendor inventory, it can be easy to forget those risk reassessments and periodic due diligence reviews. So the vendor risk management team should be setting reminders for other stakeholders to perform their duties at a specified time. Moving on to vendor owners, these are the individuals that interact with the vendor on a day-to-day basis. So they're probably going to be found throughout different departments in your organization. And because they're regularly working with the vendor, they're going to be the first to identify any risk involved in their relationship. Vendor owners should be involved in all stages of the life cycle, from the moment you're planning for the relationship and doing that first risk assessment to when the relationship ends and you need to offboard the vendor. Risk and performance monitoring is also done by the vendor owner, and they should basically just be following the requirements put in place by the vendor risk management team, like doing those risk reassessments and initiating due diligence whenever it's needed. And they should also be collaborating with their vendors to make sure they're following processes correctly, like submitting acceptable due diligence documentation on time. Since vendor owners are identifying and managing the risk in the relationship, it's clear that they're going to have a lot of responsibilities. So during the onboarding stage, vendor owners are going to research the vendor's background to get a better understanding of their qualifications and reputation. They're also going to complete something called an inherent risk assessment, which is usually a questionnaire that an organization develops that has simple yes or no questions about the vendor relationship. Vendor owners are also going to be responsible for preparing their vendors for due diligence. Now, this is really important because, as many of you know, the due diligence process can be extremely time-consuming with a lot of back and forth communication with the vendor. If the vendor owner takes the time to prepare the vendor on those expectations of what they'll need to submit and when everything is due, that can create a much more efficient process. And of course, vendor owners should also be engaged with ongoing risk monitoring, periodic risk reviews, and due diligence. The last main role in vendor risk assessments are subject matter experts, also known as SMEs. These are the individuals who have in-depth knowledge about a specific risk domain, such as business continuity, cybersecurity, or financials. And they don't always need to be internal. Many organizations rely on external SMEs to review their vendors' risk domains. What's most important is that these SMEs are qualified, which usually means they have some sort of certification or license, like a certified public accountant. Their main role is to perform a technical review and assessment of the vendor's documentation to review that the vendor has the required controls. For example, a cybersecurity expert would review a vendor's cyber documentation to verify that the vendor has sufficient safeguards in place, such as penetration testing and incident management procedures. Here are some of those responsibilities in more detail. An SME should be consulting with the vendor risk management team to establish a questionnaire that will be given to the vendor. And I just want to clarify that this questionnaire is something that the vendor completes, not the vendor owner. The SME should review that questionnaire and any documentation that the vendor provides. And while doing those reviews is incredibly important, that's just half of the process because they should also provide a written assessment of their findings. And that assessment should describe whether they discovered any issues that require remediation. An example of an issue might be a business continuity plan that hasn't been tested in several years. The SME should also be involved with issue mitigation. So going back to that example of a business continuity plan, that's going to be an issue if this is a critical vendor. So you might decide to mitigate this issue by requiring the vendor to test its plan within a certain time frame after you sign the contract. Now that we've covered those main roles and responsibilities, it's time for our first poll question of the session.
And this brings us to the first poll question of the day. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. As a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This question is, which statement best describes your current risk assessment process? We provide a standard questionnaire to every vendor before selection and contracting. Our process includes internal and external questionnaires and risk-based due diligence. We use an internal questionnaire and collect standard due diligence. Other or not sure? Christine, we have some time now to answer a question from the audience. And this question is, should senior management be involved in reviewing vendor risk assessments?
I would say that there should be some level of senior management involvement if the risk assessment is on a critical or high-risk vendor. One of senior management's responsibilities should be reviewing and approving critical and high-risk vendors. So that process would include reviewing that written assessment from the subject matter expert to make sure that any issues have been identified and remediated. But overall, for all other vendor engagements, senior management's involvement is more at the oversight level of making sure that the vendor risk management team, vendor owners, and subject matter experts are performing their duties correctly. If your credit union has a lot of vendors, it wouldn't really be a good use of senior management's time for them to do an in-depth review of each element of the vendor risk assessment.
Thanks everyone for answering that poll question. Here are the results. By the way, you may have noticed reactions such as a thumbs up or heart coming across the screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right-hand corner of the slide widget, which will expand the slides to full screen and no longer show the reactions. Also, before we move on, in the related content widget, you'll find our How to Review Third-Party Risk with Vendor Risk Assessments ebook. This is a handy resource to grab as it walks you through what to look for in a risk assessment and how to articulate the resulting information to your organization's stakeholders. With that, I'll hand it back to you, Christine.
Okay, let's move on to the elements involved in vendor risk assessments. The first element is that inherent risk assessment, which tells you what types of risks are naturally involved in the engagement and whether it's critical to your credit union. The next element is collecting due diligence, which will give you all of that vendor information from questionnaires and documentation. SME reviews are the third element that will give you that qualified opinion on whether the vendor's controls are effective. And the last element is the residual risk determination, which is basically the leftover risk once the inherent risk is mitigated. I'll explain this in more detail later on, but just keep in mind that residual risk will always be equal to or less than the inherent risk. Now, I mentioned before that due diligence is an element of the vendor risk assessment process, but I also want to explain how risk assessments play a role in due diligence. So when the vendor owner performs that inherent risk assessment, they're going to identify the types and amounts of different risks. So this can mean that a vendor engagement has high levels of reputational and compliance risk, but maybe low levels of cybersecurity risk because they're not handling any sensitive data. Once these risks are identified, you can then determine what types of vendor questionnaires to use. It wouldn't really make sense to give a complex cybersecurity questionnaire to a vendor that's not going to have access to any sensitive data. That inherent risk assessment will also be important to determine what types of vendor information to collect and review. So if your vendor does have access to sensitive data, you're going to want to collect things like cyber policies and testing results. And the inherent risk assessment will also help you decide how often you're going to do risk reassessments and update due diligence. Typically, you're going to schedule those activities at least once a year for high-risk and critical vendors. Now let's take a quick look at how to define different risk terms. You'll notice that these three terms are used quite a bit in third-party risk management, so it's important to understand the different meanings. The most basic definition of risk is exposing something to danger, harm, or loss. This can either be physical risk, like a natural disaster that causes damage to a building, or something more abstract, like a vendor's poor service that damages your reputation. Inherent risk exists naturally within the vendor's product or service. So a vendor that's providing customer service to your members on your behalf would have inherent reputational risk. Inherent risk is always assessed without considering any existing or future precautions. In other words, you're looking at this risk as is and not thinking about how you can mitigate it. Inherent risk is usually rated on a tiered system of low, moderate, or high. And finally, residual risk is what remains after controls have been implemented. So if a vendor has inherent reputational risk, you might implement some type of controls to ensure a certain level of quality. This leftover risk would then be considered your residual risk. Criticality is the second aspect you'll determine in the inherent risk assessment, but I just want to make it clear that this is not a risk rating. It's a classification of either yes, this vendor is critical to our operations, or no, this vendor isn't critical. Criticality is related to the business impact a vendor would have if it failed or went out of business. So any products or services that are necessary to sustain your operations or comply with regulatory requirements would be considered critical. And you might be wondering, what about a vendor that is providing one critical product and several non-critical products? Well, that vendor would still be considered critical because of that one product. The three questions listed here are good examples of what you can use to determine criticality. If you answered yes to one or more, then that's a good indication that the vendor is critical to your operations. Here's a side-by-side view of criticality and inherent risk. All of your vendors should be classified as critical or non-critical, but the inherent risk ratings will have some variation that range between low, moderate, and high. If you're partnering with a single vendor that provides multiple products and services, that's going to expose you to multiple types and levels of risk. But that overall risk rating will be attributed to the highest level of risk. And also, many people assume that critical and high risk go hand in hand, but that's not always the case. It's entirely possible to have dozens of high-risk vendors, but only a few of them are considered critical. And it's also possible to have a few critical vendors that are moderate risk. Before I get into a sample inherent risk questionnaire, I want to spend some time on different risk areas and considerations. The NCUA specifies 7 types of risk in their guidance, including credit, interest rate, compliance, and reputational risk. But I also want to highlight a few others that are good to know. So operational risk refers to vendors that can disrupt your operations or impact your members through incidents like a system failure or natural disaster. Information security risk is related to things like cyber attacks and data breaches that can occur because a vendor doesn't have effective security controls in place. And concentration risk can refer to a couple different situations. The first would be if you have a single vendor that provides multiple high-risk or critical products and services. Concentration risk can also occur if you have several high-risk or critical vendors located in the same geographic region. In addition to those 7 risk areas, the NCUA also highlights several considerations for risk assessments, including exit strategies. An exit strategy generally involves either moving the outsourced activity to a different vendor, bringing that outsourced activity in-house, or discontinuing the activity altogether. When you decide on an exit strategy early on, even before you sign the contract, that's going to help create a much smoother transition when the time comes to end the vendor relationship. So here we have a sample questionnaire with questions separated by inherent risk type. As a reminder, this questionnaire would be something that your vendor owners will complete because they're going to have that in-depth knowledge of the vendor's product or service. These questions here are pretty basic, so I would recommend collaborating with other stakeholders to develop your own questionnaire that's more specific to your organization's needs. And as I mentioned before, it helps to ask simple yes or no questions because that gives you a more straightforward assessment. When you're reviewing dozens or hundreds of risk assessments, it's going to be a lot easier to have these simple responses. A couple of the questions have different response options outside of yes or no, but they're still pretty straightforward, only being high, moderate, and low. Here are some other questions to consider related to areas like transactional, compliance, and financial risk. Again, I just want to emphasize that many of these questions might need to be adapted to use in your own questionnaire because every credit union is different. One of the questions under financial risk is, will the product or service cost exceed $50,000 per year? That dollar amount is, of course, going to look different for everyone, so you shouldn't think of these questions as the standard that have to be used exactly as they're written. And even under compliance risk, these are mostly asking about regulatory compliance, but you may want to consider asking questions about compliance with your own policies. But overall, these questions can be a good starting point for developing your own questionnaire. Now I want to shift over to the topic of due diligence, which is the activity that takes place after the inherent risk assessment. This slide shows you some examples of what to collect from your vendors. Some of the information you'll be able to gather yourself, like the address, locations, and website, but a lot of the information will need to come directly from the vendor itself. So for any vendor, regardless of inherent risk or criticality, they'll want to collect that basic information that helps confirm whether the vendor is a legitimate business and in good standing. Vendors that are critical or high risk will need additional due diligence so you can better understand the types of risk and control environment. This generally involves the review of any questionnaires or statements provided by the vendor. And vendor questionnaires and statements are important to review, but it's also essential to validate those responses by reviewing evidence. It's always possible for the vendor to answer something incorrectly on a questionnaire, so collecting that evidence will help ensure you're identifying any discrepancies. Some of the evidence you might collect would be internal policies and procedures, audited financial statements, stock reports, and testing results. I know due diligence can be kind of an overwhelming process, so I want to approach it by describing it in 3 simple tasks. First, it's validating the legitimacy and good standing of the vendor. And this is done by gathering that basic information I mentioned before, as well as looking at any negative news or litigation that the vendor probably isn't going to voluntarily disclose. Reports from the Better Business Bureau and Dun & Bradstreet are also helpful, as well as completing a check through the Office of Foreign Assets Control. The second task is reviewing all of that information to determine what mitigating controls are present and effective. So it's not enough to simply confirm that the vendor has a control like a business continuity plan. You also have to make sure that it's actually effective by looking at the testing results. And this task is done by your SMEs who are qualified in those risk domains. The last task is determining residual risk or leftover risk, which I'll explain in just a bit. In this next section, I'm going to talk about how to perform due diligence based on the vendor's inherent risk. So each slide is going to describe the inherent risk based on the vendor engagement and some of the mitigating control areas that should be assessed. Mitigating control areas basically refers to the systems or processes your vendor has in place to manage that type of risk. And you'll also see some suggested due diligence items that can be used to validate those mitigating controls. The first inherent risk is a vendor who accesses, transfers, processes, or stores sensitive information. Because that vendor has a lot of control over sensitive information, you'll need to evaluate several control areas. You obviously want to make sure that the vendor's technology systems are capable of protecting your information. So some of those control areas would be the vendor's system and network security and threat and vulnerability detection. In addition to making sure the vendor's systems can protect your information, it's also important to consider whether their employees and staff are also capable. Human error is actually one of the leading causes of data breaches, so things like thorough background investigations and regular security training are the types of controls that can mitigate this risk. And as far as due diligence items, there's a lot of things you can collect from the vendor, like certifications, SOC reports, testing results, and a list of their critical vendors. This next type of inherent risk is a vendor that only has access to sensitive information through your system. Unlike the previous example, they're not storing, transferring, or processing the information themselves, so the control areas and due diligence items are a little less extensive. For example, this type of inherent risk wouldn't require a mitigating control of network security because your sensitive information isn't stored on their system at all. However, threat and vulnerability controls would still be important to ensure that the vendor is protected from threats that could eventually gain access to your system and expose or steal your information. A lot of the due diligence items would be the same, but you generally wouldn't need to collect vulnerability and penetration testing results because, again, those types of cyber incidents wouldn't impact your sensitive information. This next type of inherent risk involves a vendor who is directly interacting with your members or clients. This could be something like an IT support vendor or one that provides member acquisition services. Since this type of vendor engagement can have a huge impact on your reputation, those mitigating control areas would include things like reputation analysis and human resources, which should be in place to make sure that the vendor's employees are properly trained and monitored for their performance. Other mitigating control areas would be things like privacy and compliance, especially if those interactions involve your members' sensitive information. And the due diligence you would want to collect include relevant certifications and licenses, as well as policies and procedures. For this next inherent risk, we're looking at a vendor whose service disruption would create a material impact on your operations. Now, that term material impact is one that your credit union would need to interpret or define for itself, because even regulators themselves don't have a specific definition. The NCUA's guidance on third-party relationships does mention materiality a few times, but it doesn't give strict criteria for that term. So some of those mitigating control areas would be the vendor's internal communication and approvals, service level agreements, and business continuity and disaster recovery plans. And in order to evaluate those control areas, you would want to collect and review certain information, like the vendor's business continuity and disaster recovery testing results, relevant policies and procedures, and potentially a SOC 2 Type 2 report. Significant cost would be another inherent risk, but again, this would be different for every organization. Your board and senior management will generally be the ones to determine what is considered a significant cost. And that cost could be related to onboarding or implementing the vendor service, managing the vendor throughout the relationship, or even the cost of replacing the vendor if needed. Some of these mitigating control areas would be internal communications, SLAs with monitoring, and the financial health of the vendor itself. A vendor that has poor financial health can potentially create what's known as a domino effect, where other areas like the vendor's performance and cybersecurity practices are negatively impacted. For example, if a vendor is struggling financially, they might decide to cut back on their cybersecurity program, which could then expose your credit union to additional cybersecurity risk. Due diligence items to review would be things like applicable certifications and proof of regulatory compliance, as well as financials such as income statements, balance sheets, and cash flow statements. This last inherent risk I'll cover would be one that occurs if your vendor has unescorted physical access to your facilities. So access management and human resources are really important control areas because you'll need to know exactly who is going to be on your property and make sure they're trained in things like compliance, privacy, and information security. For these types of vendors, it's good to collect a list of employees who will have access to your facilities and evidence that the vendor has conducted background checks on these employees. It's also important to collect evidence that these employees have been properly trained in things like privacy and compliance. All relevant policies and procedures should also be reviewed, as well as the vendor's access management process, which would tell you details such as how they revoke access from an employee who leaves their company. Now, what happens when you can't obtain something during due diligence? I'm sure at least some of you have had this issue before with vendors who are either unwilling to provide something, or maybe they're just unresponsive even after multiple requests. It's not that uncommon for vendors to be reluctant to provide something if it contains sensitive information about their security processes. So if that's the case, you might want to suggest an alternative. Maybe the vendor would provide a redacted document or be willing to review something in person or virtually so they don't have to hand over a physical document. And any alternatives or exceptions to due diligence should always be approved by the board. So whatever the reason is that you can't obtain something, it's always important to document your effort. This will show auditors and examiners that your credit union did everything it could to obtain the information from the vendor and got approval from that highest level at your organization. And this brings us to our second poll question of the day.
Our second poll question of the day is, what is your biggest challenge in assessing vendor risk? We don't have a standard process for identifying inherent risk. Vendors are unresponsive to due diligence requests. Due diligence reviews are too time-consuming. We don't have time to perform risk reassessments, other or not sure. Christina, I have another question here that we can answer from the audience.
Okay.
Great. Can the inherent risk assessment and due diligence review be done by the same person?
I wouldn't recommend this because the process is more accurate and effective when the responsibilities are divided among different stakeholders. So that inherent risk assessment should always be done by the vendor owner or vendor manager who is going to have that daily interaction with the vendor. Vendor owners are going to understand the vendor's product or service, but they might not be qualified to review things like cybersecurity controls or financials. And if these reviews were done by someone who doesn't have much experience in those risk areas, there's a good chance they're going to overlook some gaps or ineffective controls that can negatively impact your credit union. For example, someone who isn't a financial expert might look at a vendor's financial statement and think that everything looks good just based off of one or two data points. But there's actually a lot of red flags that can be found throughout a vendor's financials, and it's better to have someone who's qualified at identifying them. So all that to say, due diligence reviews should only be done by qualified subject matter experts who can say whether the vendor engagement is worth pursuing. And remember, these can be internal or external to your credit union.
Okay, here are those results. Thanks again, everyone, for taking the time to address this poll. Before continuing, I would like to direct your attention to our 7 steps of risk-based vendor due diligence infographic and matrix. As we just discussed due diligence examples based on risk levels, be sure to check out this resource for more helpful information. Christine, back to you.
Now that we've reviewed inherent risk assessments and due diligence, let's move on to the next activity and what you're going to do with all that information you collected from the vendor. This is where your SME reviews will take place, and their task is divided into 2 parts. The first part is reviewing and assessing those questionnaires and due diligence documents. Remember that your SMEs should be qualified in the risk domains they're reviewing. So this means that you're probably going to collaborate with multiple SMEs, which can either be internal or external. After each of these different SMEs review those documents, they should provide qualified opinions related to these 3 areas. The SME should state whether your credit union has sufficient risk practices and controls in place to manage the vendor's risk. And they should also provide recommendations on how to remediate any gaps or weaknesses in the vendor's controls. So if that gap is something like an untested business continuity plan, the SME might state that the vendor needs to get that tested before you sign the contract. And the SME should also be the one to approve any remediation before the issue is closed. After the SME completes the review, you can then use their opinion to decide on a risk handling technique. The first technique is avoidance, where you just choose not to engage with the vendor at all. The second technique is to mitigate the risk by implementing controls, which is usually the most common in third-party risk management. You might decide to transfer the risk, which usually means implementing an insurance policy to protect against the financial loss in the vendor relationship. Or you could even decide to accept the risk as is and not take any additional precautions. But this should always be done at the appropriate level in your organization, which can mean board or senior management approval if this is a high-risk or critical vendor. Since mitigation is one of the most common risk handling techniques, I just want to briefly explain the goal and some examples. The goal of mitigation is to reduce the occurrence, likelihood, or impact of risk by applying controls. These can either be internal controls that your organization puts in place or external controls that your vendor has. And I just want to emphasize that those external controls might be implemented by your vendor, but it's still your organization's responsibility to verify that they exist and are effective. And that's where due diligence comes into play because you're collecting evidence of those controls. Many of the examples listed here can be controls that your vendor has in place, like dual authentication and biometric screening, or annual compliance training and testing. The last control about geographically diverse data centers might be a control that your credit union has in place to mitigate concentration risk. Now I want to shift over to the concept of residual risk, because this is actually the risk you're assessing to determine whether you want to proceed with the vendor relationship. So inherent risk is what naturally exists in the vendor relationship without any of those mitigating controls like dual authentication and compliance training. Residual risk is the remaining risk that occurs after those controls have been applied. And this will always be equal to or lower than inherent risk. Now here's a simple visual that shows you how to transition from inherent risk to residual risk. So that inherent risk is assessed with those internal and external questionnaires that are completed by the vendor owners and vendor. Those mitigating controls from due diligence are then assessed by the SMEs who determine whether they're effective. And then what you have left is that residual risk, which is basically been filtered out of that inherent risk. Once you have that residual risk rating, it's important to know how to use that information. A very common mistake is using that residual risk to establish your risk management practices. You might think that because the vendor's residual risk is low, that means you don't have to monitor its performance regularly or perform due diligence as frequently as a high-risk vendor. Your vendor risk management practices should always be based on the inherent risk. So residual risk is used to determine whether the risk has been mitigated enough to be acceptable for your organization's risk appetite. It's also used to show your confidence in the controls that have been applied, as well as to identify the riskiest relationships. And it also helps demonstrate the effectiveness of your third-party risk management program. If every one of your vendors has the same residual risk rating, that might be a sign that something is off in your risk assessment process. Okay, let's look at two different examples of a residual risk determination. This first one shows a high level of inherent risk and also a high level of residual risk. In other words, you haven't been able to mitigate the inherent risk and there's no change in the residual risk rating. This would be a good time to stop and review the risk handling technique you're using just to ensure you haven't overlooked any additional controls that you can implement. Or maybe this means you need additional insurance to lower that residual risk. And in some cases, that residual risk just cannot be lowered, and you might just decide you have to accept it. The second example is more common, where you might start with a high level of inherent risk and then apply those mitigating controls so the residual risk is reduced to a moderate level. If that moderate risk rating is acceptable for your credit union, you can then decide on the timing for your next risk review. But remember, the timing will still be based on the inherent risk. That residual risk might be moderate or even low, but your ongoing monitoring activities like risk reassessments should still be done at a frequency of the inherent risk. Those mitigating controls might become ineffective or obsolete, so it's important to still treat the vendor as high risk or critical if that's what the inherent risk assessment stated. This is another helpful visual that shows how inherent risk is unbalanced without any controls in place. So you might have a vendor that is inherently high risk because of these factors like state licensing requirements or access to sensitive information. These risks occur regardless of any controls that you're going to apply, which I'll show on the next slide. Now you can see that this inherent risk is balanced with those mitigating controls on the opposite side. That state licensing requirement is mitigated by ensuring that the vendor is fully licensed. And that risk that occurs from payment processing would be mitigated by ensuring that the vendor is PCI certified. As those mitigating controls are applied and verified by evidence that you collect from the vendor, that inherent risk is lowered to a moderate level. Now we can finally come to the end of the process and complete the vendor risk assessment. If your credit union decides that the residual risk is acceptable and you want to officially select the vendor for onboarding, you'll need to document the evidence, communicate those results to the vendor owner, and schedule the risk reassessment and follow-up for any remediation that may be necessary. And it's also important to establish and maintain metrics for tracking the vendor's risk and performance. This step would also be a good time to establish an exit strategy so you'll know how to end the vendor relationship safely. So completing a risk assessment doesn't mean that's the end of managing the vendor's risk. Ongoing monitoring is a really important activity that helps you address any issues that might be unresolved. It also confirms that the vendor is meeting its SLAs and other contract terms throughout the entire relationship. Risk reassessments are also part of ongoing monitoring and should follow a regular frequency like the one showed here. High-risk and critical vendors should be reassessed annually, while moderate risk vendors can be reassessed every 18 months to 2 years. And low-risk vendors can be reassessed every 3 years or at contract renewal. But remember that it might be necessary to perform risk reassessments outside of these frequencies if there are any changes in the relationship, like performance issues or new regulatory requirements. And just a final note about periodic risk reassessments and due diligence, you can start the process by confirming with your vendor owners that nothing has changed. The inherent risk assessment doesn't necessarily need to be reproduced, but can usually just be reviewed and updated if necessary. If the inherent risk is the same, you can then update the due diligence documents and have them assessed by your SMEs. The residual risk can then be updated if needed. Some due diligence documents like insurance certificates or SOC reports can expire, so it's best to keep track of those dates and request them as needed rather than waiting for your scheduled due diligence reviews. And next we have our last poll question of the session.
Our next poll question is, does your credit union perform periodic risk reassessments and due diligence? Yes, we follow a formal schedule according to the vendor's risk and criticality. Yes, we perform these activities before contract renewals. No, we only perform these activities when there are issues with the vendor or not sure. Christine, let's go ahead and answer another question from the audience.
Okay.
And that question is, when doing a risk reassessment, should we ask the vendor to complete a new questionnaire?
This is a great question because I know it's a common challenge for a lot of organizations to get this type of information from their vendors during that initial risk assessment. And then when it's time to do it again, this can cause some frustration on the vendor side who might not see the point of doing the same questionnaire, especially if it's super long. So the good news is that you generally won't need to ask the vendor to fill out a new questionnaire each time you're doing a risk reassessment. What you can do instead is just give the questionnaire that the vendor already filled out and ask them to verify that all the answers are still correct. And if there are any changes to the vendor's questionnaire, like if the vendor implemented a new information security system, you can then collaborate with the vendor risk management team to determine whether you need to collect any additional due diligence documents.
Great, thank you so much, Christine. We have about 20 seconds left on our open poll questions, so please get those responses in soon. And we will be closing out in just about 5 seconds. Thanks so much. And here are those results. Thank you everyone for answering this question. Quickly, I would like to mention that we have our Inherent Vendor Risk Sample Questions and Next Steps ebook and questionnaire in the related content widget. This is an ebook and sample questionnaire of how to navigate inherent vendor risk. Let's continue with the presentation. Back to you, Christine.
I've covered a lot about the process of vendor risk assessments, and I just want to end today's session with some notes on regulatory expectations. Here are 3 regulations from the NCUA that are specific to third-party risk management. The first one on evaluating third-party relationships provides a pretty comprehensive framework that covers those risk considerations I mentioned earlier. The second is a questionnaire that shows credit unions how regulators will assess their programs. And the third regulation is specific to compliance risk and gives some expectations on how the board and senior management should have oversight responsibilities in third-party relationships. These next 3 regulations aren't from the NCUA, but are still good to know for your program. The interagency guidance is, of course, intended for banks, but it provides a lot of in-depth information on the third-party risk management lifecycle. The lifecycle is something that's really easy to follow, and I recommend getting familiar with it just to use as a supplement to the NCUA's guidance. The FTC's safeguards rule is also relevant to third-party risk management, and the CFPB's compliance bulletin is one that basically states that organizations shouldn't be working with third parties that can harm their customers or members. And here are some specific NCUA expectations on how credit unions should be performing vendor risk assessments. They should always be performed before starting the vendor engagement, and they should be ongoing throughout the relationship. The NCUA also states that third-party risk management should be based on the level of risk, and critical activities should have the most oversight. And lastly, all of the activities listed here, like risk assessments and planning, due diligence and monitoring, should all be appropriate to the size, complexity, and risk profile of the vendor relationship. To end today's session, here are a few key takeaways from all the information that I covered. Vendor risk assessments involve multiple stakeholders like vendor owners, SMEs, and vendor risk management teams. There's 4 key elements of a vendor risk assessment, and the inherent risk and criticality should always drive the scope and frequency of your vendor risk management activities. And finally, always remember to document your processes for assessing vendor risk. Thank you for joining today's session, and I hope you learned something new that will make your own vendor risk assessment process more effective.
Great, thanks so much, Christine. Before we dive into more questions and answers, I would like to thank everyone for attending. I would also like to thank Christine for her time and sharing some important information. On your screen now, you will see our upcoming webinars. On May 7th, our Vendor Contract Management for Beginners webinar, and on May 9th, our Performing a Complete Vendor Contract Review webinar. We hope you will be able to join us for those sessions. A link to register for those is in your copy of today's presentation slides. Let's now go ahead and answer some more questions that have come in during this session. Okay, Christine, our next question is it recommended to create a single vendor questionnaire or different variations based on risk types?
Well, I would recommend first understanding some of the standard questionnaires that are available to see if, excuse me, those might work for you. So Shared Assessments has the SIG questionnaire that covers multiple risk domains like cybersecurity and compliance management. And NIST also has a few cyber-specific assessment tools and resources. And Cloud Security Alliance also has a questionnaire for cloud service providers. But in addition to those standard questionnaires, you may want to consider developing supplemental questions for additional risk domains like AI or ESG, if that's something that you want to focus on. So I would say maybe, start with those standard versions, and then depending on the vendor's inherent risk, you can build on that with other questions that your credit union develops. If that helps.
Great. Our next question is, should questionnaires be limited to yes or no answers?
For inherent risk questionnaires, I think it's a good idea to use a yes or no format because it's very straightforward. So it's going to be a lot easier to calculate the risk rating because you won't have to consider any additional commentary from the vendor owner. So if you were to use open-ended questions, that's going to require some interpretation, and your risk ratings could be inconsistent if each product and service has a different vendor owner. But for your vendor risk questionnaires that are completed by the vendor, those can be more open-ended, so you can gather more information that you'll need to review during the due diligence process.
Great. Our next question. Are questionnaires necessary for low-risk vendors like a landscaper or janitorial service provider?
Yes, you should still be doing an inherent risk questionnaire on each vendor engagement, even if they're low risk and non-critical. This is going to confirm that inherent risk rating and provide the documentation and evidence that shows your credit union is assessing each vendor. Vendor risk questionnaires, on the other hand, might not be necessary for every vendor. Your landscaper probably isn't going to have any access to sensitive data, so it wouldn't really make sense to give them a questionnaire asking about their cybersecurity practices. But even for those low-risk vendors, you'll want to make sure that you're still validating and documenting your reasoning for why they're exempt from those questionnaires.
Great. Our next question. How does the inherent risk assessment differ when it's based on the product or service versus the vendor?
So that inherent risk assessment should always be done at the product or service level first because that's going to identify all of the risks in the vendor engagement. So you're looking at an individual product and determining things like whether it has access to sensitive data, or if you're using that product to meet regulatory compliance. Once each of the vendor's products and services have been assessed, you would take those highest ratings and apply that to the overall vendor relationship. So if one product has high compliance risk and another product from that same vendor has low compliance risk, that overall risk rating at the relationship level would still have high compliance risk.
And our next question. Should we be doing a residual risk assessment in addition to the inherent risk assessment?
So I would actually use the terms residual risk review or determination instead of assessment, just to kind of separate those two concepts so it's clear that they're used for different purposes. Referring to a residual risk assessment might cause some confusion about assessing the same risk twice to get two different ratings. So that inherent risk assessment is more of a formal process that includes the questionnaire and criticality classification. And this is where you assess the risk to determine how it will impact your credit union and members. But the residual risk is reviewed, so you can determine whether it's acceptable to move forward in the vendor engagement.
Great, thanks so much, Christine. Unfortunately, that is all the time we have left for questions today. Thank you, Christine, for taking the time to address some of those that came in. Any questions we did not have time to answer with you today, we will address offline. We would like to thank you all for attending and hope you found today's session valuable. Another big thank you to Christine for her time and great content. You can ask even more questions inside of our third-party think tank, which is an online community that is dedicated to third-party risk professionals and also free to join. Just because today's session has ended doesn't mean the conversations and questions must. You can post your questions at thirdpartythinktank.com and see what your peers have to say. In that community, you will find thousands of free educational resources related to third-party risk management topics, including vendor risk assessment. If you would like to become a member of Third Party Think Tank, you can register on the site or shoot us an email, and we will get you registered and send you a link to set up your password. We did record today's session, and that recording link will be provided to you in a follow-up email that you will receive tomorrow afternoon. Also in that follow-up email will be the survey link for you to request a CPE credit. On behalf of Vinminder, it has been a pleasure. Thank you and have a great rest of your day.